So Dave's Gym then, this was a question from the ACCN2 paper, which was a mixture of financial and management accounting from the old AS specification. So this dates back to June 2016. So Dave is the sole shareholder of Dave's Gym Limited. The company's income is in the form of membership fees received from customers. Income has been falling due to increased competition. Dave has decided that to be competitive, he needs to install new state-of-the-art computerized gym equipment. He intends to install the new equipment in June 2016. The cost of the equipment is £240,000. The equipment has a useful life of 5 years, and the business policy is to depreciate gym equipment using the straight line method on a month-by-month basis. Okay, so remember that depreciation isn't going to have an impact on cash flow, but buying £240,000 worth of equipment probably will. Dave prepared a cash budget and forecast income statement for the month of June. The income statement showed a loss of £4,500 for the month. This included the depreciation on the new equipment. The cash budget showed a large overdraft, which meant that the purchase could not be afforded. Okay, so Dave has ruled out, I think, spending £240,000 on gym equipment. I don't think many people would have that amount in their bank account. So Dave is proposing to rent the equipment and to amend the membership scheme. He's provided you with the following information. There are 225 members who each pay a subscription of £30 per month. Dave will introduce a new annual membership. A member will pay a fee of £300 for the year in advance. The forecast is that, this will attract an additional 50 members who will start paying on the 1st of June. So he's still got his 225 members paying £30 a month, but he's hoping that 50 new members are going to start paying on the 1st of June, and they will pay £300 for that year in advance. The rental of the new gym equipment will cost £6,200 a month. This will be paid on the 1st of each month, starting on the 1st of June 2016. If Dave purchases the equipment, then it will automatically be covered by the manufacturer's guarantee. So that's if he spends out £240,000, which he can't afford. However, as Dave is renting the equipment, he will have to take out a maintenance contract costing £2,400 a year. This will be paid in full on the 1st of June 2016. Okay. Operating expenses of £6,500 per month are paid in the month they're incurred. These will not change whether the equipment is bought or rented. And the balance in the bank at the 31st of May 2016 is expected to be £880 overdrawn. Okay, so a lot of information there. We've got an overdraft at the start of the month, £880. He's going to have some extra money coming in. So he's already got customers paying him, 225 people pay him £30 every month. So he's got that coming in each month. But in June, and only in June, he's going to get an extra £300 times 50 members. So an extra £15,000 hopefully coming in just in June. He's got to pay out the rental for the new gym equipment. He's also going to be paying a whole year's worth of maintenance contract and his operating expenses. Okay, no depreciation. So the first thing you're asked to do is prepare the cash budget for the month of June, assuming the equipment is rented and the new membership scheme is introduced. Okay. Now, the second thing we're asked to do, I'll just warn you about this now, is calculate the revised profit or loss for the month of June, assuming the equipment is rented and the new membership scheme is introduced. Now, if you remember, David calculated that he was going to make a loss of £4,500, okay, but that included depreciation. So what you need to do is get rid of the depreciation from that, because we're going to calculate the revised profit for the month of June, assuming that the new membership scheme is introduced and he rents the equipment. So he's not really buying the equipment. So in terms of profit, he's not going to have any depreciation, but he will have the rental of the equipment. He'll have 1 month's equipment rental instead. Okay, he's got the extra money coming in from the members, but be careful with that because it's annual membership. So it's not all going to accrue as profit for the month of June. Remember, if you receive income in advance, you've got prepaid income. So he's actually received 12 months worth of income, but only 1 month of it belongs in June. The other 11 months are prepaid, so they don't belong in there. So just be careful how much you include the new members in there. And then same with the maintenance contract. We're prepaying it. He's going to pay 2,400, I think it was. Let's just have a quick look up here. £2,400. He's paying it all in June, so it'll be a cash outflow in June. But actually, in terms of expenses, it's going to accrue at the rate of £200 a month. So although he's paid the whole lot in advance, most of that is going to be a prepayment. We only want June's to be included in there. So what you've got to do then is work out with a cash budget for the month of June. So that's from scratch. So take into account all his income, his monthly fees, and 1/12 of his annual fees, and then work out the profit. And don't forget that you've got prepayments in terms of income and expenses.